everyone. Thank you for joining us here in Washington, D.C. this evening for a conversation with Federal Reserve Chairman Ben Bernanke as he takes questions from teachers about the Federal Reserve and the economy. My name is Rose PIANALTO, and I work at the Board of Governors, and I am looking forward to moderating tonight's session. Here in the boardroom of the Federal Reserve, we are pleased to host 60 educators who teach economics and history to young adults. We are also joined via video conference by educators from all over the country who are participating in local events at their regional reserve banks and branch offices. And we also have many who are viewing this exchange via webcast. Through this session, we seek to promote teaching and learning about the Federal Reserve as we approach the 100-year anniversary of the Fed. We also hope to provide insights into the Federal Reserve's goals and activities so we can support the work that you do with students as you teach them how the decisions made by the central bank affect them and their families. Throughout our event this evening, Twitter users can follow the Federal Reserve Board's feed at Federal Reserve and join the discussion about the event by using the hashtags FedTownHall and FedHistory. Today, we are honored to bring you Federal Reserve Chairman Ben Bernanke. Before coming to the Board of Governors, Chairman Bernanke worked as a professor of economics and public affairs at Princeton University, where he then chaired the Department of Economics. Chairman Bernanke left Princeton in 2002 to serve as a governor of the Federal Reserve System. In 2005, he became chair of the President's Council of Economic Advisors. He returned to the Federal Reserve as the chairman of the Board of Governors in 2006. Chairman Bernanke grew up in Dillon, South Carolina, and he and his wife, Anna, also an educator, have 2 children. Thank you for joining us today, Mr. Chairman.
Hi. How do you like my living room? Thank you. Thank you, Rose, for that introduction. Tonight marks the 3rd time in just a little over 3 years that the Federal Reserve System has hosted a Teacher Town Hall. And I'm very pleased to have the opportunity to speak with educators, both those of you here in Washington, D.C., and those who are watching at Reserve Bank gatherings around the country. I look forward to your questions in a few moments. But let me begin by briefly discussing an important milestone for the Federal Reserve, its centennial, and the opportunity that occasion forwards us to teach and learn about the Fed's origins, history, and role, and how this institution has helped shape the nation's economy and financial system. President Woodrow Wilson signed the Federal Reserve Act, which established the Federal Reserve System, on December 23, 1913. As the 100th anniversary of that event approaches, we have several reasons to look back at an eventful century. One important reason is to better understand what historical experience can teach us about how best to respond to current challenges. For example, as many of you know, the bold measures the Fed took in response to the recent financial crisis reflected in part its determination to avoid repeating the same sorts of mistakes it made before and during the Great Depression of the 1930s. Similarly, our commitment to safeguarding price stability is reinforced by memories of the costs of high inflation during the 1970s and the Federal Reserve's subsequent restoration of price stability under Chairman Volcker during the 1980s. Beyond the insights that the study of the Federal Reserve's first 100 years offers to economists, historians, and policymakers about how the Fed can best meet its objectives today and in the future, a second reason to mark the centennial is the opportunity it affords to educate young people about the Federal Reserve and its important role in promoting a healthy economy and a stable financial system. When I was an educator, I quickly came to understand that students are most motivated to learn when they can see the connection of the lesson to their own lives. The Fed and its activities and economics in general can seem remote from daily concerns. But as teachers, you can show students how the Federal Reserve's decisions concretely affect them and their families. The Fed's actions influence the overall strength and stability of the economy, as you know, but they also affect the cost of a mortgage, the prices of goods and services, and the health of the job market that your students will soon be entering in many cases. Economics also complements and enriches the study of history. When I took history classes in high school, we spent much of the time memorizing dates and important events, revolutions, wars, elections, the passage of laws, and so on. While I appreciated the need to be familiar with such milestones, I remember feeling that I would like to know more about the lives of ordinary people at those times, not just about kings and queens and presidents. In college and graduate school, I studied economic history, and I found what I was looking for. For me, economic history added critical context by zooming in on the conditions of ordinary life, how people earned their livings, what their wages would buy, the extent to which they felt economically secure, and the pace of economic change that they faced. Appreciating what the lives of ordinary people were like at various times and places helped explain the larger events, the wars, the revolutions, and the elections as well. By the same token, understanding history also requires an appreciation of the role of key economic institutions, including central banks like the Federal Reserve. When I was in graduate school, my teacher, Stanley Fisher, introduced me to the work of Milton Friedman and Anna Schwartz, which demonstrated that monetary policy can have enormous effects on how the economy performs, for good or for ill. That realization helped motivate me to specialize in graduate school and after in monetary economics and related fields. Similarly, for your students, it's impossible to understand the Great Depression, America's strong economic performance after World War II, or the recent financial crisis without learning about the Federal Reserve and the debates that have surrounded it. Learning about the Federal Reserve and about economics more generally will help students in their daily lives by helping them make better financial or career decisions, for example, and by helping make them more informed and critical citizens and voters. Learning about the Federal Reserve and its economic context will also give students a deeper understanding of history, as I noted. Yet there's one more reason why we at the Fed hope to use the centennial as an educational opportunity, to maintain and strengthen the democratic accountability and the effectiveness of this institution. Traditionally, like other central banks, the Fed was reluctant to explain its policy decisions or otherwise engage with the public, partly based on a belief that this approach increased the effectiveness of monetary policy. However, this lack of openness became increasingly out of step with other institutions in our democratic society. It also reduced the effectiveness of Fed policies by inhibiting public understanding and discussion of policy goals and strategies. This approach began to change in the 1990s when the Federal Reserve began to regularly provide more information about how it saw the economic situation and how it planned to respond. Increasing the Fed's transparency, openness, and accountability has been one of my top priorities as chairman. A more open Fed, in my view, is both a more effective and more democratically legitimate institution. Indeed, the complex challenges we face as a nation are best addressed in an environment of informed public discourse, which is only possible when policy decisions are made in as transparent a way as possible. The centennial may be just an accident of the calendar, but any time is a good time to help more people learn about the Fed and what it does to enhance the economic well-being of Americans. It's often said, alas, accurately, that teaching is a thankless profession. So let me close by thanking you for what you give to your students. Our country and our economy need informed citizens who can think independently and critically. More pertinent to today's meeting, let me also thank you for your interest in teaching your students about the history and the role of the Federal Reserve. As many of you have discovered, the Federal Reserve has a variety of classroom tools available through our educational portal, federalreserveeducation.org. Notably, the system's economic and financial education staff is introducing today a set of 3 lesson plans that examine the past 100 years of central banking. I hope they'll provide you practical help in your classes. Thank you for participating in today's event. I look forward to your questions and to an interesting discussion of the Federal Reserve's past, present, and future. Thank you.
Thank you, Mr. Chairman. And now we're going to go for our quiz. For our first question, we'll go to a teacher in the room. We have one over here.
Good evening, sir. My name is Randy Martinson. I'm a social studies and German teacher at Parkdale High School in Prince George's County. I just want to say it feels like I'm at Disneyland. However, how would you explain monetary policy in an exciting way to an 11th grader?
That's a great question. I'd start with making sure the 11th grader understood about interest rates. Short-term interest rates, which are interest rates on short-term loans of various kinds. Long-term interest rates, like mortgage rates, which affect the cost of buying a home. And then I'd also help them first, again, understand how interest rates are important in the economy, and in particular, how interest rates affect the incentives that people have to make purchases, to borrow, to spend, and to engage in economic activity. For example, if mortgage interest rates are low, a student ought to understand that that makes the cost of owning a house lower, cheaper, and makes them more likely to buy a house or to rent a house and to put people to work building or furnishing those houses. Likewise, if the interest rate on auto loans is lower, the person's more likely to go out and buy a car. Again, putting auto workers to work. So you can think of interest rates as being a kind of fuel for the economy when interest rates are low. More people will buy houses, cars, businesses will be more likely to invest in new equipment. That's going to put people to work. That's going to create more energy in the economy, so to speak. And likewise, when you have high interest rates, all else being equal, that means that fewer people will buy houses, fewer people will buy cars, and so on. So interest rates are essentially a lever for moving the economy. Now, the Federal Reserve, which is the central bank of the United States, makes monetary policy, which for practical purposes means controlling short-term interest rates and influencing other interest rates in the economy. When the economy is moving too slowly, like it is today, growing at a pace below its potential, with unemployment too high, inflation very low, the Fed tries to heat up the economy, tries to make it go more quickly by lowering interest rates, which is what we've done. We've held short-term interest rates close to zero, and we've taken other steps to bring down longer rates, including mortgage rates as well. At other times, when the economy is moving too quickly, it's overheating, inflation is becoming a concern, the Fed can raise interest rates like Chairman Volcker did during the 1980s when he was fighting inflation, slow the economy down, and achieve lower inflation, for example. So that's basically the basic idea between monetary policy. It's important also to note that the Fed has a dual mandate. We have two targets, two objectives. One is price stability, which means low inflation. The other is maximum employment, which means basically trying to put people back to work when there's a lot of unemployment in the economy. And we speed up or slow down the economy as needed to try to get the best results we can. So I think that's a basic summary. As I mentioned before, on federalreserveeducation.org, there are some, besides lesson plans, there are some simulation games. I know kids like to play games, and this is an opportunity to pretend to be me, which I don't know why they would want to do that, but they can. So there are ways of doing that. The other thing I guess I would suggest, I already indicated, was to try to relate what the Fed does, what monetary policy does to their own individual lives. What mortgage rate do their parents have if they own a house? Have they refinanced lately? What does that mean? How does the cost of a car loan affect what their monthly payment would look like? Those kinds of things. What is inflation? Why does it matter? Motivating for them in a personal way why these things the Fed tries to manage, why they are so important for everybody in the economy. I think that gives a stronger reason for them to want to understand, what the Fed does.
All right, I have a question from Jennifer Davidson of the Nebraska Council on Economic Education in Lincoln, Nebraska. Can you explain the dual mandate of the Fed to target both the price levels and the unemployment rate? When was the unemployment rate target added? And please comment on the long-term and short-term of each mandate. How do you balance the two?
This is a good follow-on from the previous question. So the Federal Reserve is accountable to Congress, it's accountable to the American people, and it's Congress that tells us what they want us to try to achieve. And the objectives of Federal Reserve's monetary policy are the dual mandate, maximum employment, and price stability. That was part of a law passed, I think, in 1977, which gave the Fed discharge for our monetary policy. Now, we have recently put out, I think in January 2012, and it's on our website, we put out a statement of policy principles which explains our basic framework for thinking about monetary policy. And in doing so, we talk about the dual mandate both in the long run and in the short run. So let me do that. In the long run, we're concerned again about inflation and about jobs. In the long run, inflation is basically controlled by the Fed, by monetary policy, and so we can establish a target. And what we've said is that we think that price stability in practice corresponds to an inflation rate of about 2% a year. Why not zero? Well, because zero is too close to the area where prices are falling, which is called deflation, and we know from the Great Depression, we know from the experience of Japan, we know from other places that deflation is not good for the economy. So to give a little bit of breathing space from deflation, which is negative inflation, we aim for about 2% inflation in the longer term. In terms of maximum employment, at any given time, there are going to be some people unemployed, even in a healthy economy, because they'll be changing jobs, entering the labor force, looking for work, and for other reasons. And so we don't aim for zero unemployment, just as we don't aim for zero inflation. We try to help the economy get to the best and lowest unemployment rate that it can sustain, that it can manage. And our best estimate of the lowest unemployment rate that can be sustained in our economy is around 5 to 6%. And that's where unemployment has been during healthy periods. Right now, of course, it's over 7%. So it's high right now. So that's where we try to go in the long run. And in the short run, we essentially are using interest rates to strengthen the economy or slow the economy in order to get as close as we can to those longer-term objectives. Now, most of the time, those two objectives are complementary. For example, an economy that has low inflation, stable prices, typically will also be healthier overall, will generate more jobs, and that way we are meeting both of our objectives. Right now, we're not at our objectives on either inflation or on unemployment, but we're missing on both of them in some sense in the same direction. Inflation is very low right now. It's below 2%. So for that purpose, we need a stronger, more rapidly moving economy. And likewise, unemployment at 7.3 at the moment is above what we think could be sustained in the longer term. And so there also we need a stronger economy. So in keeping interest rates low and stimulating more rapid growth, we're really moving towards both parts of our mandate, trying to achieve both sides. There are times when the demands for price stability and maximum employment are moving in opposite directions, and so there's a bit of a trade-off temporarily. But when we are in a situation like that, which, again, we're not there today, we try to take a balanced approach, which means that we're trying to manage both sides of the mandate, trying to get them both over time to our longer-term objectives.
Great. I have a question from Michael in Dallas. With the decrease in middle-class incomes in the past 4 to 5 years and the potential for fewer work hours, where do you see the potential for economic growth for the middle class?
Well, one of the key things to understand about the Fed and monetary policy is we can have very important influences in the shorter term, the short to medium term, when monetary policy has its greatest effects. But monetary policy cannot have powerful effects in the very long term except on inflation. So when we talk about middle class incomes, the disappearance of the middle class, the hollowing out of the labor market, those kinds of issues, we have both a short-term and a long-term issue. The short-term issue is basically that we're still recovering from what was by far the deepest and most serious recession of the post-war period, the worst recession since the Great Depression of the 1930s. The unemployment rate hit 10% about 4 years ago. It's still coming down very slowly, still above 7%, as I noted. Wages, therefore, have not grown very quickly. A lot of people have been out of work for 6 months or more. So with the labor market being weak, it's understandable that family incomes are not where we'd like them to be, and that's the reason why the Fed is aggressively trying to promote job creation, job growth, put people back to work, and in doing so, we will help increase incomes and increase average standards of living in the economy. But that's a short-run phenomenon. We're trying again to get the economy back to a more normal state. Now, over the longer term, going back at least 30 years or more, there has been a growing tendency towards greater inequality, more income and wealth held by the top 1% or fraction of 1%, less held by people lower in the income distribution. There are a number of reasons for that. They include the interaction of new technologies, globalization, and skills. So, for example, if you are a highly skilled worker, you can use new technologies, computers, robots, whatever, then you can make a very good living because you're participating in a global economy where there's a huge demand for these high-tech types of skills. Whereas if you are a low-skilled worker, then you're essentially competing in a global economy with literally billions of people who are earning much less than you and earning low wages and have low levels of skills, and that's going to put downward pressure on what you can earn and on your employment opportunities. And so that general phenomenon, plus other changes in our society, has been creating greater inequality in our economy. There are various ways to approach it, but I think it's certainly most appropriate sitting here with so many teachers to say that, fundamentally the most important thing that we can do is give people appropriate skills. And that means skills ranging from being an inventor in a garage all the way to being somebody who can effectively use a complicated machine in the context of the workplace. And those are the skills that have the highest return. But again, given these long-term trends, it's going to take some very powerful forces to turn this around. And unfortunately, just bringing us out of the recession and into a stronger economy was certainly going to help, but it's not going to solve the long-term problem.
Next, we'll go to a teacher in the room.
Thank you very much. My name is Timothy Wilson, and I teach at Surrattsville High School in Prince George's County, Maryland. My question is this. For students concerned about the United States national debt, how do you reassure future tax-paying adults that the American economy can absorb continued high levels of borrowing without sacrificing growth and stability?
Well, that's I would say $64 billion question, but I think that's probably too small. So it's always important to start with the fundamentals, and I would make sure the students understand what deficits are and what debt is. So the deficit, of course, is the difference between what the government takes in, or I should say what it pays out in terms of all kinds of spending, and what it takes in terms of taxes and other revenues. The deficits in the U.S. recently have been quite large, primarily because of the recession itself. The recession was a very severe one, as I mentioned, and with many people out of work and with business profits down and so on, tax revenues have been significantly below normal, and so the deficit was quite large. Now, over the last few years, as a combination of a stronger economy, which means more tax revenue, and changes that have been made by Congress to spending and taxes, the deficit actually come down quite a bit, where we're looking to be as low as about 2% of GDP in 2015 on current plans. So which is actually a relatively low deficit. So that deficit has come down in the last few years. Now, the debt, a different concept, is the total amount that we owe. And so each year, you add the deficit, this year's deficit, plus the interest payments on the existing debt, add that onto the debt, and that's how the debt grows over time. So the debt is always growing. A useful concept is the relationship of debt to the overall GDP of the economy, Right now, the federal debt is about 72% of the US GDP, just like the amount of mortgage payments or mortgage debt that a family can afford depends on their overall income and wealth. Likewise, a big rich country like the United States can afford more debt than a small country without the kind of wealth that we have. So as deficits have been large for the last few years, debt has risen and as I said, is now over about 70% of GDP. Now, as we look forward and try to answer your student's question, we have both short-run and long-run considerations. I think the real issue that your future taxpayers should worry about is the long-run sustainability of fiscal policy, of the U.S. Debt situation. As the years roll by going forward, all of us who are baby boomers are going to be retiring, and that means more Social Security and Medicare payments. Other programs will continue to expand. Healthcare costs are going up, as you know, which makes the cost of healthcare programs higher. Productivity may grow more slowly. Population is aging, as I already mentioned. So projections, which obviously are only projections and therefore are not precise or certain, but projections of the long-term deficit is that it will get much larger. And the place to look for this, by the way, really good source of information is the Congressional Budget Office, the CBO, which is on the web and publishes regular studies and reports on the deficit and makes projections of it. Anyway, the current CBO projections say that under current law that the deficit will continue to grow in the next few decades and eventually become much too large relative to the economy. So that does suggest that there is an issue, a problem, and that involves, addressing that problem involves taking actions soon to try to put our long-term fiscal picture on a more stable footing. So that's very important. The short-term issue is a little different. As I said, deficits have been coming down, not up, in the last few years as the economy has strengthened. And one of the main factors that helps the deficit come down actually is a stronger economy. And ironically, to the extent that fiscal policy cuts too quickly, cuts spending, raises taxes too quickly, it can actually be counterproductive in the sense that if the government cuts programs and cuts its spending, that actually can cost jobs in the short run. That means fewer taxpayers, less revenue, and it actually can be sort of counterproductive. So the trick here, I think what is the most sensible way forward is for the government to continue to be careful. I mean, obviously, we want to make sure that the government money is spent in an intelligent way. We want tax code to be as fair and as efficient as possible. But I think that we're better off being a little more careful in the short run about not doing anything that will slow down the recovery and prevent people from getting back to work, while at the same time making sure that we have addressed the long-term issues to make sure that when your students are in the workforce and paying taxes, that the deficit and debt of the U.S. will be sustainable and manageable.
Okay, a question from Lenny Briones of DeBakey High School in Houston, Texas. Can the Fed do anything to increase employment, or is 7% the new normal?
Well, again, going back to our mandate, we want to achieve maximum employment. That's what the law says. What does that mean? Well, as I mentioned before, our estimates of the lowest unemployment rate that the U.S. economy can achieve is probably somewhere in the range of 5 to 6%. Why not zero? Again, because at any given time, there are going to be people moving between jobs, coming into the labor force. There'll be some people whose skills are simply not appropriate for the jobs that are available. And so we don't expect to get zero unemployment, but we do think that we can get to 5 or 6%. Now, that long-run rate of unemployment is primarily determined by factors other than monetary policy, such as the efficiency with which workers and jobs are matched. It's interesting to try to estimate how much the internet, for example, has improved job finding. and other factors like the mix of industries, the skills of the population, and a variety of other aspects of the labor market. So I think 7% is not where we are going to be. I think we will, I hope sooner rather than later, get back to a more normal unemployment rate somewhere in the 5 to 6% range, although I hasten to add that that's an estimate and could be a little higher, could be a little lower. Unemployment's been as low as 4.5% in the last decade, but, you know, and of course, it's been as high as 10% a few years ago. Now, what the Fed can do, again, we can't really change the, very significantly anyway, we can't do much about the long-run unemployment rate or the long-run sustainable unemployment rate. But what we can do is in the short term, when there's a shock to the economy like the financial crisis that drives unemployment way above that normal level, we could be part of the solution by using monetary policy to push, to help the recovery and to bring the unemployment rate back down. So no, I don't think 7% is as good as it gets. I think the unemployment rate will go down. I think the labor market will get stronger. There are long-term changes in our labor market. We just talked about inequality. Another one is that participation rates, the share of the population that is in the labor force, either working or looking for work, has been going down. That's partly the aging of the population. That's partly the fact that the share of women who are working in the labor force, as opposed to in home or in education or as students, that has stopped rising, has begun to come down a little bit. So a variety of social and other forces that are affecting the number of people working. But again, I do think that right now we're still in an incomplete recovery from the deep recession, and that the labor market for your students in a couple of years will be looking even better. Of course, they stay in school, finish their degree, go on to college, do all the things they need to do to make themselves attractive employees. Of course, that'll make things all the more easier for them.
We have a question from Scott Helsel. With interest rates so low, how can I help my students understand the importance of saving? And how do I answer the question I am frequently asked, why should I put my money in the bank at interest rates at almost zero?
Well, there's good reasons for interest rates being low, and it isn't, despite my simple description at the very beginning, it isn't just the Fed that makes interest rates low. For one reason, inflation is very, very low, and so that's a reason for interest rates to be low. When inflation is high, people demand a higher interest rate to compensate them for the loss of purchasing power when they make a loan or save money. Another more fundamental reason why interest rates are low is that the economy just isn't performing at the level we want it to perform at. And that's true not just in the United States, but even perhaps more so in some other advanced industrial economies. And when the returns on investment are low, as is in the case when an economy is not performing at full capacity, then it's just difficult to make any investment that's going to give you a high return without undue risk. So unfortunately, low interest rates for the time being are a fact of life. I expect that interest rates will rise over time. But right now, I would agree with the student that interest rates are just quite low. That doesn't mean, though, it's not important to save. Even if interest rates are low, you're still putting away part of your income or your earnings. And with inflation very low, that saving is going to hold on to its value, its purchasing power. Putting aside part of your income to save, to build wealth, is critically important as you go forward in life. If you want to pay for an education or make a down payment on a house, one of the changes in the housing market is that larger down payments are becoming required in many cases, if not most. So if you want to become a homeowner someday, you need to have some money put aside. Saving is a good habit. It's a good way to begin a process of building wealth over your lifetime. And we talked about the inequality of income and wages across people. The inequality in wealth is far greater than the inequality in income. A very large share of the population only has it, and I'm talking about, people who've been working for many years. A very large share of the population only has wealth of a few $1,000s that they can put their hands on. That's not very good if you run into some kind of medical emergency or become unemployed or have some other problem. So, it's very important for young people to get in the habit of saving. Interest rates will be higher in the future, but putting aside part of your earnings, part of your income for the future is good. It's good training, and it's a good way to become more future oriented. And there's lots of reason to think that people who think about the future don't think only about immediate gratification, will be more successful on many dimensions, not just financially.
Next, we'll go to a teacher in the room.
Good evening, Chairman Bernanke. My name is Keisha Maddox from Overlea High School in Baltimore County. And my question is, given the ups and downs of the economy, along with the increasing use of technology by employers, what are some of the best careers for high school students and college students to consider that we can talk to them about now?
So that follows up with our last question about saving, and this is about getting a job. One thing I'd suggest for your students, just as an assignment, would be the Bureau of Labor Statistics, BLS.gov, puts out a projection, I believe this is correct, a projection of where the future demands for jobs are going to be, what professions, what industries. I'm sure that healthcare is very far up there. I think education must be pretty high, construction, a few other areas. So students can actually get a little bit of a sense of where the jobs are going to be and think about it accordingly. Naturally, consistent with what I was saying about the income distribution, some of the highest paying and most rewarding jobs are in what's called the STEM fields, STEM, science, technology, engineering, and mathematics, for those students who are prepared to train in those areas, and that could be at a high professional level, it could be in a more supporting role, but students who are interested in those areas and can get degrees in those areas have a lot of opportunities. But in general, I would argue that the best thing you can do is work hard, get your degree, practice workplace skills. I think it's, what's the reason to give homework? Well, one reason is to get the students to learn more. Another reason is to teach them to do something on time and get it in when it's expected. Everybody's going, no, I know. But those kinds of skills are really important. Punctuality, responsibility, those things, at the most basic level, that's really a good place to start. More generally, you should try to do something that you're interested in or that you love, because that'll make you more motivated and more excited and make you work harder and in a more dedicated way. But in any case, the world doesn't always provide exactly the most optimal thing. Not everybody can be an NFL quarterback, so it is important to be flexible, to try to do things that will give you a chance to learn on the job or in a new situation. One good thing about the United States is that we have quite a diverse educational system. People, for example, even older folks who find that their skills are not what they'd like them to be, they have the choices of junior colleges, community colleges, technical schools, on-the-job training, all kinds of programs that are out there. And it just takes a certain amount of initiative and flexibility to go out and do what's necessary. So again, to answer your question, I think that you can look and see where the jobs are going to be, and again, skills are really important. That means staying in school. That means if you're interested in STEM fields, working in those areas. But in the end, everybody's got to do what they find interesting and rewarding, and you'll be better off finding a field, finding a job that you think is worthwhile and lets you exercise your skills and talents, than trying to do something which you really don't like and are not really committed to.
a question from Catherine Hudson of Dayton High School in Springfield, New Jersey. Why is it so important for our students to learn financial literacy?
Well, I think you all basically have your good instinct about why that's the case. Again, financial literacy just means knowing how to pick a mortgage, knowing how to save or invest, knowing how to plan a family budget, all these, how to choose a car loan, all these basic things that adults have to know how to do if they want to have a good standard of living are just really tied up with understanding the basics of personal finance. And I'm really pleased to see that financial literacy is becoming an increasingly big part of high school and even middle school curricula. So I commend those of you here who include that in your classes. It's also important for the country and for the economy, I should just say, because when we have a smart, disciplined, financially literate population, you're going to get better financial products, you're going to have better competition among financial firms, which leads to better results. You're going to maybe avoid some of the problems we had during the financial crisis when we had all these bad loans and so on, which, you know, to some extent reflected people not knowing exactly what they were getting into. So it's very, very important for individuals trying to build a better life, trying to build wealth, trying to make pay for a house and for education for their kids and so on. And it's good for the country and for the economy. Now, a very important question, which I don't think anybody really has a perfect answer to, is, well, how do you get kids to learn this stuff? It isn't that easy, and the research on it is kind of mixed. My own sense, and I know this from my wife's experience as well, is that kids like to role play, and there are some really good programs like Junior Achievement's Finance Spark program, which involves kids spending some weeks in class learning the basics of buying insurance, buying a car, making a budget, all those things, and then they get to go to the Finance Park, and there's a simulation where they are given a role to play. You know, you're a teacher with such and such an income and so many kids and so on, and what are you going to do? How are you going to make ends meet? I'm sure it's a question that comes to your mind all the time. And kids really like it. I mean, they really get into it and enjoy it, and it's a very useful type of teaching tool. The other context that seems to be successful is that people really are motivated, obviously, when they are about to actually make a financial decision. So it's probably a good idea for people to have in their minds that, well, when the time comes to buy a house, when the time comes to take out a student loan, another example, that would be the good time to talk to a counselor or somebody who can help them make that decision. And that's when they're really, really motivated to try to understand the issues and the choices.
I have a question from Linda Poole in St. Louis. Given the continued growth of big banks since the Great Recession, do you believe there is enough controls in place to minimize the likelihood of a similar event and another round of too big to fail?
Well, that's an incredibly important question, and one that's engaging a lot of our attention here at the Fed and here in Washington in general. We're doing a lot of things to try to address too big to fail, and try and avoid a repeat of the financial crisis. One set of tools that we're strengthening is the requirements that banks hold a lot of capital and a lot of liquidity. Capital means that they finance themselves through shares from shareholders as opposed to debt or deposits. And banks that have lots of capital can, if they lose money, then in some sense it's their own money or their shareholders' money they're losing, rather than defaulting on debt or defaulting on deposits and creating a crisis situation. So we have new capital rules that require banks to be financed to a greater extent by equity rather than by debt, and I think that's important. Also, as I mentioned, higher liquidity requirements means they have to hold more cash or cash-like instruments, such as treasury bills, on their balance sheet, so that if there is a run like the run in 2008, that they'll have the cash to pay off or finance themselves despite the run. So that will certainly strengthen and is strengthening the banks. We as part of that capital process, by the way, we every year put the big banks and medium-sized banks as well through what's called a stress test. And what we say is, let's pretend that the economy goes into a deep recession, that the market crashes, that house prices drop 25%, et cetera, et cetera. What would your balance sheet look like in that case? And we force them to go through that exercise, and we make sure they do it in a reasonable, sensible way. And we don't allow them to pay dividends to their shareholders unless they can show that they have enough capital to withstand a really serious crisis. So that's one set of things that we've done. The second set of things that we, and when I say we here, I'm talking about really all the regulators, not just the Federal Reserve, is we are toughening considerably the rules, the supervisory rules that we apply to banks. For example, the regulators are working on something called the Volcker Rule, which is named after a former chairman of the Fed, which would reduce the ability or eliminate the ability of banks to make investment bets on their own account as opposed to as agents for customers who are wanting to buy and sell assets. And so that will take some of the risk out of the banking system. And finally, and this is very important, to eliminate too big to fail, you got to have fail. You got to put fail in there in the equation somewhere. A well-known economist once said that capitalism without bankruptcy is like religion without sin. You got to have the ability to fail if you're going to have any discipline on the behavior and performance of any large institution, whether it's a bank or some other kind of company. So one of the important innovations of the Dodd-Frank regulatory reform is the creation of what's called an orderly liquidation authority, OLA. As you probably know, the FDIC, the Federal Deposit Insurance Corporation, already has the authority to take small and medium-sized banks essentially into bankruptcy, into receivership, protecting the depositors and trying to protect the communities and the financial system as well. Well, what the Orderly Liquidation Authority tries to do is give the FDIC, in cooperation with the Fed, the tools it needs to safely take even an enormous multinational bank or other financial company into a wind down without having the terrible effects on the rest of the system that the collapse of the Lehman Brothers company and the other stresses of 2008 had on our financial system and our economy. And they've made a lot of progress on that. Fed is working with them. But ultimately, unless you're in a situation where the creditors of the shareholders, the other creditors of large institutions actually worry about losing money, then you're not going to have the market discipline that you really want to have. So we're making a lot of progress on these issues. I think we still have more to do. And I think we have made progress. I think that it's too early to say whether the problem has been or will be completely solved. If it's not, then I think additional steps, would be warranted. But for the moment, we have a plan, putting it into place, and meaningful progress has been made.
Okay, next we'll go to a teacher in the room.
Hi, Phil Sessoms, Freedom High School in Loudoun County. Chairman, you've noted that inflation is currently pretty low, and yet the Fed is, through its policy of quantitative easing, injecting money into money supply constantly, by some estimates, about $3 trillion over the last several years. Why do you think that hasn't led to inflation? And then, taking it a little farther, what do you think would lead to inflation under those circumstances?
That's a good question. So let me first say a few words about what quantitative easing is. We call them LSAPs, large-scale asset purchases. What quantitative easing is the following. So as I mentioned before, what the Fed does through monetary policy in order to stimulate the economy, to try to strengthen the recovery, is to lower interest rates. Normally, we operate on short-term interest rates, even overnight interest rates. But unfortunately for us, we have already cut short-term interest rates almost to zero, and you can't really take interest rates below zero. So we're kind of, where we can't take short-term interest rates down any lower. So what we're doing instead, we're doing several things, but one of the things we're doing is we are going out into the open market and buying longer-term securities, treasuries securities primarily, which we're financing by adding to the reserves of the banking system, not to cash in circulation, by the way, but to reserves in the banking system. And that, of course, has been increasing our balance sheet. Our balance sheet is growing significantly on the asset side. We're holding more and more securities. And on the liability side is the reserves that the banks deposit with us. It's like we're the bank's bank. The reserves are the deposits they hold with us, and that we've been scaling that up in order to try to bring down interest rates. So as we expand our holdings of Treasury securities, that tends to put downward pressure on longer-term interest rates, just analogous to normal monetary policy, and that tends to provide additional support to the economy. I think it's important to note that this is not the same thing as fiscal policy. It doesn't involve any government spending. It doesn't involve the creation of any new debt. In fact, it has actually been very profitable for the taxpayer because we take the interest that we earn on the securities that we buy and we send it back to the Treasury. And we've sent back to the Treasury in the last 3-4 years something on the order of $300 billion, which is a pretty significant amount of money. So this is not the same thing as government spending. So we've been doing that, and that, I think, has helped. It's pushed down interest rates to some extent and therefore supported the recovery. Now, why is there no inflation? Well, inflation depends basically, in the first instance, on two things. The first is whether the economy is too hot or too cold. The economy is on the cold side. There's still a lot of unemployment. Firms are not running at full capacity. So there's not much wage or price pressure. With a lot of unemployment, there's no reason for firms to raise wages, and with wages very low, there's not much pressure on them to raise prices either. So with an economy with a lot of spare capacity, the pressures for inflation are pretty low. The other factor that affects inflation is the Fed's credibility, expectations of what inflation is going to be. When people are confident that the Fed will keep inflation low, then they don't ask for big wage increases, they don't ask for big price increases, and it becomes a self-fulfilling prophecy. Expectations of low inflation can help keep inflation actually quite low. Now, the Fed's credibility is very strong. Inflation expectations have been quite stable around the 2% level, which is where we want inflation to be in the longer term. And so that credibility of the Fed, the confidence that the public has that we will do whatever it takes to make sure that inflation stays close to our longer-term target, has also helped keep inflation down. And as I noted, and as you mentioned, inflation is very low. It's only a little bit above 1%, which is below the 2% target. So that's why there's not much inflation. In fact, in some sense, too little inflation at this juncture. Going forward, the appropriate policy is analogous to what it always is, which is that as the economy strengthens, as people get back to work, as the unemployment rate falls to its sustainable level, as there is more demand in the economy, then it will be important for the Fed to normalize policy, to begin to raise interest rates, to begin to reverse in some way the quantitative easing, perhaps by just letting the assets that we hold run off, mature. That we have the tools to do. We are perfectly confident that we can raise interest rates when we have to do that. The challenge, as always, will be doing it not too early, not too late. A little bit too early, and you would tend to get a recovery that isn't as strong as you like. A little bit too late, you might get a little bit of inflation. That's the balancing act that monetary policy always faces, and has faced, as long as central banks have been in this business. But the quantitative easing part doesn't have any special implications. We can reverse that when we need to. We can raise interest rates when we need to. We can tighten monetary policy, slow the economy if we need to. And so there's an awful lot of confidence, in the markets and financial markets, that and the low interest rates, the fact that 30-year interest rates are very low, indicates that people are just not very worried about inflation, even in the very long term. And as long as the Fed has that credibility and we keep inflation low, then it'll be a self-fulfilling prophecy.
Okay, I have a question from Sherry Shepard in Glen Rose High School in Arkansas. As you prepare for the end of your time as chairman, what would you like your legacy to be?
Well, I think fundamentally, of course, that's really not for me to say. That's for others to say. But some of the things that obviously had a very eventful 8 years. There's no question about that. We have obviously we took a lot of steps to try to stabilize the financial system in 2008, 2009, and the financial system, I think, is much healthier today than it was, obviously, a few years ago. We have been innovative, I think, in finding ways to provide support for monetary policy to help the economy recover, not as quickly as we would like, but at least certainly going in the right direction. One thing, as I mentioned earlier, I think one thing that I think is very important, and which has been one of my personal objectives since I became chairman, is to increase the transparency of the Fed, to give greater clarity about our policies, why we're taking decisions we're taking, how our policies are intended to work, and so on. I think that increases confidence. I think it makes policy work better, and it also improves our accountability to Congress and to the American people. So that is certainly something that has been important to my mind in terms of what I've tried to accomplish here at the Fed. But as you know, my term comes to an end in a few months, and I wish I was leaving with the unemployment rate at 5% instead of 7%. But we have done, I think, a good bit to support this recovery, and it's important that we continue to provide the necessary support to help put people back to work and keep inflation from falling too low.
We're going to take one last question from a teacher in this room.
Good evening, Mr. Chairman. My name is Michael Linger. I teach at Bronx Early College Academy in New York City. And my question would be, who was the most influential teacher you had as a student? And what did he or she do to leave such an impression on you?
Did you come all the way from New York for the...
I left at 1:38.
Well, thank you for doing that. I've had a lot of very important teachers. And I think, what I think makes a good teacher, let me just say this first. On the one hand, part of it's about the subject matter. The math teacher or the history teacher makes you excited about you, the student, makes you excited about the subject and learning about it and understanding it. But there's also, teachers also model commitment and dedication. And I think students will respond to a teacher who they think really cares about them and cares about their learning, just on a personal level, more so even than just purely based on interest in the subject matter or whatever it might be that they're teaching. So in my own case, I went to a public high school in a small town in South Carolina. As I said, I had a lot of good teachers. I had a terrific band teacher who I was a saxophone player, by the way, we weren't the National Symphony Orchestra, I have to tell you, but she worked really hard. She worked us long hours after school to get our marching routines in good shape, and she just had a very strong commitment to individual students, making sure each student was, she would help with individual problems and things that came up that were outside of what she was teaching. I also had a very good English teacher, a very good physics teacher, and again, it was not just their interest and commitment to their subject, but also their interest and dedication to the students themselves. As I got older and went to college and graduate school, then of course I became much more interested in economics, and so I dealt with many outstanding economists. In college, I had a professor named Dale Jorgensen who was not only my advisor of my senior thesis, which was the first significant piece of individual research that I ever did, but he actually employed me for a couple of summers working on his research so that I could learn what it was like to be an economist. I mean, that's a basic thing that kids don't necessarily know, which is what is it like to do this kind of job, or and it's useful to get that. And then, as I mentioned in my opening remarks, Stan Fisher, my thesis advisor at MIT, was very influential in getting me to be interested in monetary policy and monetary economics. Stan demonstrated that he lived what he taught. He left MIT in a nice tenure professorship at MIT to do many other things, including being the first first deputy director of the IMF during the Asian crisis, and he's just finished a stint as the governor of the Central Bank of Israel. So he has had plenty of real-world experience as well as teaching experience, and that just showed his commitment to what he was doing, and he is very widely respected in that field. So been a lot of teachers who've been important to me, and again, modeling their personality, character, commitment, interest in students is just as important as their knowledge and excitement about whatever it is they're specifically teaching. Both are incredibly important, but I think that, again, that you need both, not just one or the other. I think this is an appropriate time, again, to thank all of you here. I mean, here you are coming out in the evening to talk about teaching about the Federal Reserve, trying to improve your own teaching skills and knowledge, doing something that will help your students. I think that's shows a lot of commitment on your part, all the way down from New York City. They have a Fed in New York, too, by the way.
You're not there, though.
That's true. So I commend you all for that. And as a former school board member, college professor, textbook writer, my wife has been a teacher all her life, Spanish teacher, very interested in education. I think it's just incredibly important for our young people and for our economy and for our country. So thank you for doing that.
Well, I'll let you pull your cell phone cameras out now if you want. But, so thank you for your questions. This concludes our session. And we really appreciate Chairman Bernanke for speaking with us tonight. Thank you again. And we appreciate all you educators who participated, and we hope that you learn more about the Federal Reserve that will help you teach your students about the Fed's missions and its roles. And on behalf of the Federal Reserve System, thank you especially to the participating teachers all around the country. We are pleased you could join us today. This concludes our session. Thank you.